It's the start of the new year, and if you haven't done any tax planning yet and you own your own business, there's still time to do some. The way to save money on taxes is to generally make sure that you're following the tax laws correctly and then to put money away into retirement accounts. The type of retirement account depends on many different factors, but you should be focusing on lowering your overall lifetime tax, not just your tax for this year. The first thing you need to do is to make sure you are properly expensing items instead of capitalizing them. The de minimis safe harbor rules allow any business, no matter how they are structured, to deduct any tangible, real, or personal property that is acquired, produced, or improved as long as it is under $2,500. If you have audited financial statements, then the limit goes up to $5,000, but this isn't going to apply to most people. What this means is that if you buy a piece of equipment that is under $2,500, you can expense it and you don't need to worry about capitalizing it and depreciating it. If you buy a fishing pole for $800 and it's going to be used by the clients you guide, this equipment would typically need to be depreciated over 7 years, and in the first year you would only be able to depreciate around $114. But since the cost of the equipment falls under the de minimis safe harbor rule, and it is personal property of the business, you can expense all $800 in the same year the equipment is acquired. The second thing, which isn't a deduction you have to file for, as when you complete your tax return it will be calculated by the software, is the qualified business income deduction, also known as the QBI deduction. This deduction is not available to C Corps, and the amount of income deducted depends on whether your company qualifies as a non-SSTB or whether the company is considered an SSTB, and an SSTB is a specialized service, trade, or business. Generally, a guide business is going to be a non-SSTB. However, there are some cases where certain income may be considered SSTB income, but generally that is not the case. This chart shows the QBI deduction available for single and married filing jointly taxpayers, and the examples I will be using are for non-SSTB businesses. The single category is also the same category if you are married filing separately, head of household, or a qualified surviving spouse. If your income is under $191,500 and you're filing single, or $383,900 and you're filing jointly, then you're able to deduct 20% of your business income. So if you made $100,000 in business income and this was your only income, you would be able to deduct $20,000 from your taxable income. The second category for the QBI deduction is the phase-in deduction. The phase-in deduction is calculated 4 different ways, depending on whether you have W-2 wages paid in property or not, and what your marital status is. To keep this video on the topic of tax savings and not on the specifics of calculating deductions, I'm going to avoid examples for the second category. The last category is the 3-step check. The first step is to figure out what would have been your 20% deduction. The second step is to then do 2 calculations. The first is 50% of your W-2 wages, and the second is 25% of your W-2 wages plus 2.5% of all qualifying property. And after doing these 2 calculations, you take whichever number is greater. You then look at the number from step 1 and step 2, and you take the lower of them and arrive at the QBI deduction. If you don't have W-2 wages paid and own no qualifying property, your QBI deduction can be 0. The third thing, which is something which you can control, is going to be your retirement accounts and how much you contribute, as well as what type of accounts you contribute into. There are 2 types of retirement accounts, traditional and Roth accounts. Traditional retirement accounts allow you to take a tax deduction at the time you put the money in. However, when you take the money out, you have to pay ordinary income tax on it. Roth accounts do not allow you to take a deduction when you put the money in. However, when you take the money out, you don't have to pay any tax on it. An easy way to think about this is to imagine you're a farmer, and if you would like to be taxed on the seeds you've planted or the harvest they produce. There are strategies as to whether you should use a traditional or a Roth, such as what your current tax rate is and what your expected tax rate is to be when you retire. This starts to get into retirement planning, so I'm going to just stick to what type of retirement accounts are available to you. If you have no employees and are a business owner or self-employed, the solo 401k is an option for you. In 2024, you were able to contribute as an employee either $23,000 to the 401k or 100% of your compensation, whichever is less. The employer, which is also you, can then make a contribution of up to 25% of your contribution or of net self-employment income. This has to be done before the April 15th tax deadline, and the max contribution is $69,000 in 2024, which includes the $23,000 that you can contribute as an employee. Similar to the solo 401k, there is the SEP IRA, which is slightly different and has less paperwork involved. With a solo 401k, there's an employee and an employer contribution. However, with the SEP IRA, there is only the employer contribution, which is the lesser of $69,000 or up to 25% of your income. The SEP IRA does also have a Roth version, however it was only allowed by law in 2023, so it may not be offered by everyone. Also, the SEP IRA should not be used if you have any employees. You'll need to move to something like a simple IRA. There are many different types of retirement accounts with slightly different rules, but they all have the same contribution limits. The solo 401k and the SEP IRA are likely the 2 best options for fishing and hunting guides, especially those who are just starting out. The last thing to look at is any equipment that is being depreciated because it is over the de minimis threshold. Depending on your income, how consistent your yearly profits are, and what your intended purpose with the equipment is, it may make sense to take bonus depreciation, which is 60% for 2024. When you decide to take bonus depreciation or Section 179 depreciation is up to you. You can create a business loss by taking bonus depreciation. However, the tax laws are somewhat unfavorable to tax losses. Section 179 depreciation does not allow you to create a loss with the depreciation. However, if you have enough equipment to depreciate, you could in some instances make your taxable income zero for the year. These are the areas that are going to be able to create the most tax savings. Anyone telling you to buy a vehicle or create a complex entity structure are either trying to sell you a course or they're just saying stuff for views. It's not that some of these strategies don't work, it's that they're not applicable for most people. If your effective tax rate is 24% and you spend $100,000 on a vehicle, you've just spent $100,000 to save $24,000 on taxes, when you could have just taken that post-tax $76,000 and invested it back into your business or into the stock market and made a return on it. Complex entity structures can work, however, the cost to set them up and the constant paperwork needed to keep them active and functioning legitimately make it so that they don't make sense unless you're making multiple millions of dollars in profit.